Okay, jumping on, we have seen the ASX today fall, I think at the worst part, about 4.3%. I'm recording this about 3 p.m. on Monday, March the 9th. And I just wanted to jump on and have a bit of a chat around, what do we do when we see share markets and markets fall significantly in a very short amount of time? So number one, what I'm saying is, if you are watching this, I'm not talking to you who are sophisticated and you're a trader and you moved to cash a month ago because you're a professional and you've got the best crystal ball in the world, and because you timed the market right the last 2 times, you can do it again. I'm not actually talking to you. I'm talking to people who are out there who are like me, who are like most of my listeners. And I'm talking to them to say that volatility in markets is part of the deal when it comes to investing. So what we're going to do first is I'll share the screen and you can see here. So I am recording this at 10. Well, this is Yahoo. It's a little bit delayed. Usually it's delayed by 20 minutes or so, but you'll get the point. At the moment, about 3.3% drop. So it will probably close between where it is now recording and neg 2. There was a bit of shopping around lunchtime on the markets, and this is the ASX 200, which is the 200 biggest companies by weight on the Australian Securities Exchange. But I just want you to have a look there. Like, I'll just show you this. If we have a look over the last 1 year, coming out of the tariff tweets and Liberation Day, the markets, they've rebounded quite strong. And then, when the Iran war really started, markets have had a bit of a tumble. If we have a look at the last 5 years, we're basically back where we were before Liberation Day. And it's important to note, everyone, that when you see charts like this, and here is the GFC, basically, the fall off on the GFC, COVID there looks like a blip when we zoom out. When you see price charts like this for any shares, for any stocks, for any indices like this, it's the actual price chart, number one. So it doesn't include accumulation. Sure, you can have a look at the accumulation index, but it's the share price. So while the shares have been moving up and down or lower or higher, companies are still producing dividends. But the reason I wanted to jump on today is just to acknowledge that you're going to open your super account, you're going to open your investment account, you're going to see the news tonight and in the coming days, and it's going to be like horror stories, because remember, bad news sells. And as much as I'm effectively in media and benefit from when I do a post or a small bit of content like this, lots of people want to look at it. I want to be a voice of reason to say, stop, slow down, and zoom out. When in doubt, zoom out. So if we have a look at the fundamentals of our investing, we don't want to buy shares or growth assets with a hold time of less than 5 to 7 years, as far as I'm concerned. I'm not buying shares. Remember, I've carved out those who are trading and are getting cute. I'm talking about those who are looking at their superannuation, looking at their share portfolio that, at the end of last year, you set up your share portfolio to be like, I'm going to invest. I'm going to invest for at least 5 to 7 years. When you open it today, don't be a hypocrite and sell it out of fear, because when things were good 6 months ago, you were investing for the long term. So that's another point where a lot of people say that they are a growth investor, but when the going gets tough like today, maybe you're not so growth, right? So I think that's what we need to know. But if we have a look here, over the last 5 years, if we did buy 5 years ago on the March 2021, we're still higher than it was, and I'm being very layman's term, the share price of the index 5 years ago was about 25% lower than it is today after a 4.5% drop, right? So that's one thing we need to know. We're not buying growth assets with any intention of selling them within the next 5 to 7 years. Because when stuff happens like this, knowing that we do not sell within the next 10 minutes means that, well, this is what we've trained for. Believe it or not, share markets go up and down. Crazy, right? Now, the reason that we've seen such a savage shock is around and I'm not going to get into the detail because I don't think it actually matters, whether it's a Liberation Day tariff announcement, whether it's COVID, whether it's the GFC, whether it's the war in Iran. It doesn't matter the reason. History shows us that when crazy things happen in the world, markets react. So why are they reacting right now? I'll let you know.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au, and they'll point you in the right direction.
The reason why markets can get shaky, there's a few layers here, but I'll try and dumb it down so that my friend or someone who isn't in money can understand. Ordinarily, share markets will sell off and not have as much money invested if interest rates are higher or rising. And that's because money can flee to cash and get a higher return without the risk, where when it's invested in share markets, there is more of a risk because the capital fluctuates. So number one, with interest rates rising, people and institutions might just keep money in cash because we can get a higher return just from the cash. That's number one. Number two, and this does feed into it, particularly in Australia, with the inflation issue at the moment in Australia, one of the things that they look at with inflation is fuel prices. Ta-da! So we've seen the Strait of Hormuz close at the moment, and that's putting strain on the supply of oil all around the world. And companies and countries are stressing out, and I've even seen it in my local fuel price in the last week, and so have you, that the price of fuel has gone up because of this. And what that can do is make it so inflation data is higher. And what happens when inflation data is higher? Well, interest rates need to go up because we need to slow down people's spending. So that's why, the supply of oil can impact every single economy in the world. So that's just an explainer of why it's so savage at the moment. Not to mention, it's the S&P 500. The US stock market is well inflated because of this AI stuff. So there could be a heap of companies and a heap of people taking stuff off the table now when all this is going on and just pressing reset. Now, that's very layman's term of what's going on. I know that you'll be watching and you're like, Glenn, you're a dickhead, you're not sophisticated. I know, I'm trying to talk to the people who are not in the money world. All that to say, with our superannuation, just because we see a headline tonight, tomorrow, this week, with increased volatility and decrease in the share price and the indexes, we don't log in and change our super. The reason why, your super is invested for the next 20, 30, 40 years. Why are we doing day-to-day changes right now when we don't need the money for 10, 20, 30, 40 years in the future. As an example, if we look at here on the screen, when this Liberation Day stuff happened here, markets pretty much fell, and we call that a V-shaped recovery because it's like the letter V. If you were dicking around with your super, you would have probably missed the timing of it because of the way that super fund unit prices are, and you might not have got back in, and you might have actually done worse by trying to time the market. Particularly also if you have a look back through COVID, if you tried to time the market, look at that V, like very sharp. The GFC was a little bit more prolonged in the recovery, but that's what I want you to know with your investing. We're doing it for the long term, and particularly with our super funds. Your super fund isn't invested in 100% Australian equities. If it was, you probably got bigger problems, but bear with me. If the Australian market falls today 3.5%, let's just see. Yeah, it's still down at the data I'm looking at. If it does fall 3.5% today, that doesn't mean tomorrow you'll log into your super and see it a 3.5-4% fall in your unit price. And the reason why within your fund, you're not 100% equities. You're going to have some international equities. You're going to have some Australian equities. You're going to have some Australian property unlisted. You're going to have some infrastructure that's unlisted. You're going to have a portfolio that might be 20 to 30% in defensive stuff. And some of the growth will be in unlisted property in your major super fund. So this is why trying to time the market with your super fund, and I'm putting this on the Money show. Most of our listeners are under 40, right? If you want to hear what I've got to say about Retire Right, I did a YouTube last week about moving super to cash, so you can go and have a look at that. But I'm really talking to people who are under 40, under 50 years old right now. Your super portfolios are designed to work through market events like this. A lot of fund managers will have multiple different scenarios of what happens to the portfolio when there could be this current oil price shock, high inflation, another pandemic. This is what the fund managers train for. This is what they've modeled the portfolio for. And I would really encourage you not to freak out when you see the big headline and logging in and seeing your account dip. Keep your hands off it. You do not need to touch your super fund, all right? Now, you might be saying, well, Glenn, markets are cheap. Should I be investing more money at the moment? And my answer to that is it's always a good time to invest for future you if you've got the money left over in your life and not spoken for future you after your spending plan or budget, right? So the question is, you might just do your monthly or weekly investing. You know, every week or every month we put money into our investment account, right? Awesome. You may have some extra money that you hold and you're a little bit cash heavy for, oh, well, maybe I want to go on a holiday in a couple of years, or maybe I just want to be a bit more cash heavy for opportunities. Like, is it better to buy shares and growth assets when prices are lower? Yes, it's better. So I'm not opposed to people, if they've got opportunity funds, to take advantage of lower prices, because the price is 3.5% at the moment lower today than it was on Friday. Knock yourself out, but don't do it trying to time it. And then when it bounces next week, or if it bounces next week, because we don't know, if anyone tells you they know it's going to happen, tell them they're an idiot, right? Now, if they knew what was going to happen the last 2 times, we call that luck, and good for them. But what I want you to do, if you do want to take advantage of an environment of lower prices, know that over the last 5 years, we're still we were on market highs not long ago. Literally last week, we're at an all-time high, right? So seeing these drop, I think we need to calm down a little bit, because I think some of it is going to be just a bit of heat coming out of the market. You know, all-time highs, peeps, it gets a bit jittery. But remember, today's all-time high is tomorrow's lows. And if you don't believe me, have a look at the all-time high at the GFC compared to now. Have a look at the all-time high compared to old mate's Liberation Day stuff. You know, today's all-time highs are tomorrow's tomorrow's lows if we chill out and zoom out. So anyway, I just wanted to jump on to say, as a reminder, you are a growth investor. If you want to put your money in and working for at least the next 5 to 7 years, I think that's most of us. I think we need to continue to run our spending plan and budget, so we're living on less than what we earn, and invest the rest. Remember, your superannuation contributions are probably going in today, this week, next month. You're buying lower prices anyway. So don't do anything dumb when we're in such volatile times, right? If you want to get cute and try and time the market, well, I hope you're good at timing the in and the out. And if you can successfully time the market, I suspect that you need a career change and you need to go to work for an active fund manager, because I can guarantee they'll pay you $500 $1 million a year, all right? So just know that. If you want to learn more about investing in general, I've got the book, The Quick Start Guide to Investing. It's available now. And I'll leave you with that. But just as everyone, chill out. This is what you've trained for. And if you are getting a bit squirmy right now, well, maybe, just maybe, you aren't a growth investor. Maybe, just maybe, you shouldn't have actually purchased DHHF last month because you thought, oh no, I'm a growth investor. Yeah, you are, until you have an event where your portfolio's clipped 10% in a week. Yeah, how's that going for you? So I think we just need to calm down and don't do anything dumb. Anyway, let me know in the comments here on YouTube if I'm right, if I'm wrong, if I'm an idiot. All good. If you disagree with me, let me know. It helps me make money anyway from the engagement. So thank you so much. And we'll be back to our regular programming tomorrow. Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.